Hello, everyone. Today is Friday, November 7th, and this is your 314 SMI investor update for the month of November. Fernando, how are you doing?
Doing well. Let's dive into it.
Yeah, so we are covering both September and October. September is going to be kind of fast, and we are going to, as normal, look at the 314 SMI family of funds. That's the RAA, Real Asset Allocation Fund, and the Full Cycle Trend, ticker symbol FCTE, stock selection fund. There will be a longer explanation and discussion of FCT given its recent underperformance. So let's dig in and we'll start with RAA, the easier conversation. So RAA, it's a month of September, positive month, 3.5% gainer. As usual, we look at our attribution charts here on this page. We have the assets and the asset classes. And so this was a broad-based gainer. I mean, this is an everything rally in the month of September, and it was reflected in the RAA. What was driving performance? Well, it was really gold, metals miners, and NASDAQ. So great places to be reflected in the returns. Volatility's been low, returns have been high. It's done exactly what we've wanted it to do. In September was that quintessential month where we caught that move in gold. So what happened in October? Similar broad-based move, but this was much more of an equity story. So it was broad equity exposure that powered the fund in October. We were overweight equities. There was the Nasdaq's been a perpetual overweight for the real asset allocation ETF. And then we also saw S&P 500, emerging markets, and Japanese equities help returns this month. The gold bull market stalled out in the middle of the month, and so there is still some positive returns, but obviously gave some of that back in the middle of the month. So that's the taken together, it's almost 6% returns over the 2 month period here for the real asset model. It's beating 60/40 at this point in time, year to date. Uh, and so doing what we want it to do, even despite the fact that we've had a strong equity and decent bond rally. So what is the exposure going into the month of November for the real asset allocation fund? This table is something we take from the model which underlies the fund. So model that we've run for years for our clients at 314 Research. And so you can look at it and see how the positioning has evolved over the months. And so going into November, we've been overweight equities for a string of months now, and we're now actually technically slightly underweight equities from 52% to 48%. Benchmark weight is 50%. Within that sleeve, it's really NASDAQ over S&P 500. That's the positioning. For alternatives, we've bumped up from an underweight 18% to 22%. 20% is the benchmark weight for alternatives. Again, the real story is what's happening within that asset class in this fund. We've seen uh, the model is adding to its gold position. It's maintaining its metals mining position. Taken together, that's 10% of the fund. Pretty big position there. At the same time, traditional commodities and energy is an underweight. And this is how we designed the model that underlies this fund. We wanted to split out the exposure that you get from energy and metals and precious metals in particular, because we do believe that as we go forward in this environment, there's not going to be a monolithic commodity rally. You see a lot of these monolithic commodity rallies over history. And I think there are going to be periods where metals are working and oil's not working and vice versa. And you want to have that really pinpoint exposure within your fund. And so we have that ability and it's working for us because oil has been down about 20% year to date, whereas gold's up 60% depending on when you're measuring that. And so I think that thesis of ours as we created the fund is playing out here within the fund. The fixed income bucket, it's staying steady at a benchmark weighting. And the real interesting story here is you're seeing investment grade corporate weight stay strong and high yields ticking down. And so a little bit more conservative on spread product within that section of the fund, but holding it steady at 30%. So that's the lay of the land going into November for the real asset allocation ETF. Let's turn to FCTE. For September, it was a okay month, plus 1.8%. Had a little bit of tech exposure, which is a rarity for this fund this over this post-Liberation Day rally. And so that helped it, especially having bought Oracle prior to the big move higher, and then KLAC as well. So those are the two big movers within the fund. But the story here and the thing we need to talk about is October. So October performance, the fund was down 7.1%. Now, as we mentioned, there's a model that underlies this. It's a quantitative model and system that powers this ETF and the stocks that it selects. And if you go back to the back tested history, you can see this would be the worst month, whether you're looking at the back-tested model history, the ETF's history, the real-time model history, which ran since 2021 for 314 research clients. All of this is the worst month. About 9% underperformance, negative 7.1%. The 9% underperformance makes it the worst month in history for the model. And so you can see it's a sea of red. Every major sector was down, and all the stocks except for two small, Edwards Life Sciences and Cisco were small gainers, but everything else we just got pulverized. It was a bloodbath, and it's been rough. And so I think it's time to really address this head on and think about, is this a broken system? Because it is a quantitative system that underlies the fund. And it's something that we wrote about as the 314 research this week. And we said, look, you're only as happy as there's this old phrase, you're only as happy as your least happy child. And that you could kind of apply that quip to us with our suite of models and strategy work. Most everything has worked well this year, but FCT has been a real sore spot. Whether you're looking at our strategy work, RAA, our gold work, our oil work, all that's done what we expected. But FCTE has been just brutally bad. And so it's time for us to face it head on. I think that's the only thing you can do in this situation. And so let's think about what's going on and share some of the results of this multi-month project of what's driving returns and what are our conclusions. So number one, FCTE is caught between two really historic bear markets in odd forces. Number one is a quality bear market, unprecedented quality bear market. So this is the quality 100 line. So if you step back and think about how does the full cycle trend, how does the model or system underlying full cycle trend work? Well, you take the S&P 500, you scan the S&P 500 for quality, you grab the top 100 stocks by quality, and then you trend rank them. And your trend ranking we'll get to in a minute. And you grab the top 20 stocks. It's 20 stocks, very concentrated, equal weighted portfolio. Shouldn't be too surprising it can deviate very sharply from the S&P 500 because most quality funds are still cap weighted and they're really benchmark huggers, and they are not providing you really diversified exposure. For better or worse, this strategy is definitely giving you diversified exposure, and it's proving itself like on the downside here, unfortunately, in that way. But what's going on? That quality 100, which is our selection universe, it's in a massive bear market. Quality as a factor is in a massive bear market. So that's what we're looking at here. The blue line is that quality 100. Think of it as your quality factor relative to the S&P 500. And we've shaded bear market periods for this factor. And you can see if you just scan the bottom clip, uh, there's nothing like this historically. We've never seen this factor underperform like this. Unprecedented. If we go to the next chart, it gives us another way to contextualize it. This is all the quality bear markets, just kind of indexed to 100 started. So you can see the depth and duration of the bear markets. And the light blue line is the current quality bear market. It's basically underperformed the S&P 500 25% quality as a factor. So just a nasty period, a brutal period for quality, which we'll get to in a minute. The other thing that's going on with FCT is it's an equal weighted strategy. And obviously, we're in this cap weighted era where really it's been AI, hyperscalers, mega cap tech, along with this year, a weird low quality mix as well that has led the market. And so you're seeing equal weight versus S&P 500 suffer through one of its worst bear markets ever. So we've done the same thing. We're looking at S&P equal weight relative to the S&P 500, and we're indexing the bear markets to 100 at the start. And you can see we've really only seen a couple equal weight bears that rival this one. Obviously, the late 90s tech bear market for equal weight. But even when you look at that, to this point, we've lost so much on an equal weighted strategy. It's down over 25% versus the index. We calculate this as having started at the beginning of 2023, which is really when AI exploded as a phenomenon into the markets. And so since AI's emergence, it's been a cap-led momentum market. And so if you want to outperform, it's been very difficult. You've had to pile into increasingly small number of tech stocks, semiconductors. Not all of them qualify for a quality universe, some do, but it puts a lot of pressure on these equal weighted strategies. So let's talk about FCTE particularly. This is the same look from a couple charts ago where we looked at the quality 100. That's the blue line relative to the S&P 500. Now we're looking at the full cycle trend strategy relative to the S&P 500. And when you look at these bear markets and the drawdowns on the bottom clip, what really pops out is that you can think of full cycle trend as a high quality beta strategy. So you have the quality factor that lives out there. And because of this trend overlay and the way we do it, I believe it really just creates a higher beta to that quality factor in a lot of environments. And that works most of the time on the upside if you're a quality believer. And most of the time we can identify these market environments where quality is not going to be a great strategy. That's early cycle. It's commodity led rallies like 2004 to 2007 was one of those bear markets. You saw that in 2011, 2014 when banks were leading the market and energy was also doing very well and tech was underperforming. Those periods are low quality. Those value led markets are bad for quality. In the early cycle periods from like 2009 period or 2020 period, we're coming off a recessionary bottom. That's not great for quality either. This is one of those weird times where neither of those conditions apply, yet quality is suffering. It's really about the AI trade and the mega cap trade. We did see a similar kind of bear market in the 90s for quality in the very end of the last tech bubble. Um, so there's a little bit of some kind of memory of that here. So let's go to the next chart and just kind of put some of these thoughts together. So just to wrap it up, this is the year to date, 152 stocks are beating the S&P 500. 2023 was the only worse year from a narrowness perspective. And so this is second narrowest year going back to 1960. It's pretty incredible. And the two most narrow years are these in this AI world. So in order to beat the index, you really had to pile into semiconductors, mega cap tech, Google, Nvidia in particular, and overweight portions of the market that are already overweight. Then you have some of these lower quality areas, high valuation, low quality areas like maybe Palantir, some areas of the crypto market that are also doing well this year. So it's a weird toxic mix for the quality factor, which is really looking at things like balance sheet, earning stability, returns on capital. Those are your traditional meat and potato quality ingredients. And that's not working right now, especially if you take the AI stocks out. And one of the things we do with our trend overlay within this full cycle strategy is we're buying pullbacks within uptrends, if you can find an uptrend. And those pullbacks, generally weren't happening within these hot quality areas of the market, weren't happening. So we were basically spent this post-May period within the fund having very little tech exposure in a market where you've had to have tech exposure to have any hope of beating the market, much less if you're in an equal weighted strategy. It's very, very difficult market environment here. And so that's the kind of the diagnosis. What is the prognosis? What do we see going forward here? I think that in order to declare this strategy broken, you have to decide that the quality factor itself is is broken and will be in a sustained long-term bear market. I don't see that I don't think that makes sense just from a logical standpoint. If you think about what's happening in the economy, you think about the AI trade and the law of large numbers and how large these firms are getting, in order for the capex that's being spent to pay off, the uh, you're going to need to see AI applications get adopted. And most of that, I think that first adoption, uh, where you see it in the survey data and stuff like that, is going to come from larger companies. And specifically, I think these high quality companies, maybe they have high revenues and tight margins, and they can make some efficiency adjustments to widen those margins. It has to kind of inure, those benefits have to inure that portion of the economy in order to validate all the spending in the AI technology. So if AI is going to work, it needs to have beneficiaries. And the most logical set of beneficiaries are this within this quality universe that we are selecting from. So not to mention the fact that I think to just the quality factor has proven itself over a long period of time. And these things happen. You have these weird market environments and you have you can look at it and say, okay, this one thing has happened in the economy, AI, and it has crowded out many other factors and and captured these flows to the detriment of many other traditional factors. And quality is getting the worst of it right now. So our view is that when you spin it forward, this too shall pass. It's one of those things where the AI trade has to broaden out in some way, shape, or form. Some people might want to buy Russell 2000 here. Other people might want to buy S&P equal weight. I think it makes more sense to dive back into these high quality operators that can drive efficiency gains from AI. But you can have a debate about all those different sources. But all those trades, I think, will come back in some way, shape, or form. So before we move on here, Fernando, do you have anything to add to this FCTE diagnosis and prognosis?
I think that's a good summary about how basically the stocks that have done well this year, especially they're discounting cash flows that are going to come from the rest of the economy finding value in all these AI applications. And the quality universe is a logical place to look for that value to be captured in the future. So I think it's too early to call for the death of the quality factor. And based on this work, full cycle trend is firmly in the camp of a strategy uh, that will do well in when quality is doing well. And that's just not where we are right now, but too early to say that quality is permanently dead here.
No way. Yeah. I don't think that quality is permanently dead. And so when you start having that question, it's probably about the neighborhood where you should be looking to allocate to that type of strategy. And that's not necessarily um, any kind of solicitation or promotion here. It's just that's a market truism that works and the cycles work. They ebb and they flow. So in any event, one of our clients told me, or I heard him say it on a podcast once, either you have returns or excuses. If you don't have the returns, nobody cares about your excuses. And these are our excuses, I guess, is what you would say at this point in time. So I think that it's the bottom line is it's been a rough period, unprecedentedly rough for the quality factor, unprecedentedly rough for the equal weight factor, and also unprecedentedly rough for the full cycle trend strategy. We are in, but having looked at it, sifted through the evidence, and considered the backdrop, we're still confident. We're still confident in the strategy. It will turn, in our opinion. So that is that's the November update. You want to go to the last slide and let's do you have anything else to add here?
No, I think that's a good place to wrap it up.
All right. As always, we'll be back next month. Thank you for watching.